2,000 years ago, Rome faced a choice that would echo through history, or as Marcus Aurelius might say, echo through eternity. Let the financial system collapse or bail it out. And they chose bailout. And in doing so, they wrote the playbook every central banker has followed since. Today, I'm going to tell you the story of history's first financial crisis and why it shows us the parallels to today and why the things that are happening today in our economy and have been happening for decades are not new. They're ancient. Good morning, timeless investors. Ari Van Gemeren here. I'm thrilled to have you guys again. Every Wednesday we release an article on our Substack, The Timeless Investor on Substack. Check it out in the show notes. And today's article goes into the Panic of 33 AD. And it's incredible the parallels between the Panic of 33 AD and the world we live in today. Since 2008, we have heard our central bankers say repeatedly something along this line. Unprecedented times require unprecedented measures. And as I said before, it's not really unprecedented. In 33 AD, the Roman Empire experienced a financial crisis so severe that aristocrats were facing bankruptcy, credit markets completely froze, and commerce ground to a halt. If that doesn't sound like 2008 to you, I don't know what does. And the Emperor Tiberius did exactly what the Fed did in 2008, and exactly what, in my opinion, they did again in 2020. He bailed them out. So let me tell you this story, because once you understand what happened in ancient Rome, you will not look at modern central banking the same way again. And this is the premise of this channel. This is the premise of this show. I run a real estate investment company. We acquire nice properties all across the West Coast. I am a firm believer in the power of real assets to build your wealth. But why? We live in a money printing society. We live in a society in which inflation is institutionalized. It is part of living in this country, living in the West, arguably living in the East as well right now. Everybody in the entire world is basically on a fiat printing system. And I'm also a historian. I studied history in university. I'm fascinated by the parallels between history and today. And some people say to me, Ari, who cares? Why does any of this matter? The reason it matters is very simple. The core element of human history are humans. And so long as humans are the centerpiece of history and the centerpiece today, then the things that happened in the past will continue to happen because people don't change. So by 33 AD, Rome was the undisputed superpower. The empire stretched from Britain to Persia. The Mediterranean was literally called our sea, Mare Nostrum. The denarius was the world's reserve currency. But here's something else that's really relevant in this period, other than the crucifixion of Christ, which also happened to happen at the same time. Rome was experiencing something unprecedented in ancient history: sustained peace. Augustus had ended the civil wars in 31 BC. And for the first time in generation, Romans were not killing Romans. The borders were secure, trade routes were safe. This was the beginning of the Pax Romana, the Roman peace. And peace, not to say peace is bad, but peace does something interesting to an economy. When you are not spending treasure on wars, and when trade flows freely, when merchants aren't worried about pirates or invasions, capital begins to accumulate. Money that would have gone to legions and fortifications starts looking for returns elsewhere. And so by Tiberius's reign, Rome was drowning in capital. Here's why interest rates were so low. First, the Emperor Augustus had left billions of sesterces in the treasury, an astronomical sum. That's like the Fed sitting on trillions in reserves. Second, conquest had slowed. The easy victories were mostly over. No more Gallic gold flooding Rome, no more Egyptian wheat tributes. The empire had shifted from conquest economics to management economics. And by the way, slight detour, there was a massive discussion to be had on the Roman economy in general, an economy mostly driven by conquest and capturing new slaves, right? There's a whole fascinating discussion to go on there, but that's not for this piece, but just an interesting note because I like to point out interesting things. Third, and this is critical for really understanding this period, peace meant predictability. When you know your estate won't be burned by civil war next year, you're willing to lend against it. When trade routes are secure, commercial lending explodes. Interest rates fell from 12% during the Civil Wars down to, below, I don't know, 3 to 6% under the Pax Romana. Does that sound familiar? It should. It's exactly what happened after World War II. Peace, stability, and suddenly everyone's looking for yield. But here's the problem with peace and low rates. They breed complacency. And Roman aristocrats had a cultural issue. Senators were forbidden from engaging in commerce. It was too undignified. But they needed income to maintain their status. The villas, the clients, the political campaigns, all the aspects that go into being a Roman aristocrat or politician. And land was the only respectable investment. But with rates so low, traditional state income wasn't enough anymore. So they discovered leverage. Why accept 4% returns in your family estate when you could borrow at 4%, buy more land yielding 6 to 8%, and pocket the spread? And even better, Italian land kept appreciating. Population growth, urbanization, proximity to Rome, it was the perfect asset. Limited supply, growing demand, and government favor. The senators started simple: borrow against estate A to buy estate B. But then they realized, why would I stop there? I can also borrow against B to buy C, against C to buy D. And some aristocrats owned 20, 30 estates, all interconnected through debt. They weren't even hiding it. Pliny the Younger would later brag about his leveraged land deals in his letters. And here's the critical part. Everyone was both a lender and a borrower. Senator Marcus lends to Senator Gaius, who lends to Senator Lucius, who lends back to Marcus. It's a credit circle with land as collateral at every step. And for a decade, this worked brilliantly. The Pax Romana had created perfect conditions: excess capital seeking returns, low interest rates, stable property rights, no external threats, and a growing economy. And nobody saw the risk building, because in a world of peace and prosperity, what could go wrong? Everything, as it turns out. Now, the Emperor Tiberius was not your typical emperor. While Nero would later throw wild parties and Caligula would declare war on the sea, Tiberius was austere, paranoid, conservative. He inherited this situation from Augustus, and he looked at Rome's aristocracy gambling with borrowed money, and he saw disaster coming. So in 33 AD, he did what regulators always do when they see a bubble. He tried to fix it with rules. Tiberius revived an ancient law from Julius Caesar's time, the Lex Julia de Vicunus Mutuis. I don't know if my Latin's any good. I didn't take Latin, by the way, guys, so that was a good effort on my part. This law required that 2/3 of every loan had to be backed by Italian land. The intent was noble: force capital into productive Roman agriculture, reduce speculation, bring discipline back to lending. This, by the way, parallels a more modern event very closely. President Andrew Jackson issued the Specie Circular, which required frontier farmland to be bought with specie, hard money assets, to try to curb what he saw as excesses in the system. It too led to a disaster. And here's what Tiberius didn't see, or maybe he refused to see, or maybe he saw and he didn't care. The senators were not just leveraged. They were leveraged on leveraged on leverage, as I described earlier. This wasn't individual debt. It was a web of interconnected obligations. So when lenders suddenly needed to comply with this law, they had to call in their loans to buy land, all of them at once. Imagine if today every bank in America simultaneously demanded full repayment of every loan within 18 months. That is what hit Rome at this time. What followed, guys, is, and I hate the word masterclass, but it's sort of like a masterclass in financial contagion. Let me walk you through it day by day. Day 1, lenders call in loans to comply with the law. Day 2, borrowers rush to sell property to pay the debts. Day 3, everyone's selling, but guess what? Nobody's buying. Why would you buy? So day 4, property prices start to fall. Day 5, as prices fall, collateral values collapse. Day 6, more loans get called. Day 7, the death spiral accelerates. And within weeks, Rome's credit market was frozen solid. Tacitus, the historian who lived through this, captured the panic so well. He wrote, credit was gone and property could not be sold even at ruinous losses. Think about that for a second, too. We often talk about timing the market for purchase and sale and whatnot in real estate. How hard it is to get financing to buy property when you know it's a good buy, right? Trying to get a loan in 2010, pretty tough to buy multifamily assets. This environment favors the conservative. It favors the people who have held on to cash that didn't overlever themselves, right? Those are the people that clean up in this period. They can buy properties for cash, pennies on the dollar. Trying to do this with loans is difficult, and nobody was buying, even though this is probably an excellent time to buy Roman real estate. Nobody could buy, couldn't even sell it at ruinous losses. But if you had a bunch of sesterces and gold in your bank account, maybe you would have gone out and bought, made a killing. So think about what this all means. These are Roman senators, the most powerful men in the ancient world, except for the emperor, of course. They own vast estates. They have armies of slaves. They control trade routes, but they can't get a loan. They can't sell their property. They're technically wealthy, but functionally bankrupt. Tacitus tells us that the aristocracy faced complete ruin. Distinguished families that had existed since the Republic saw centuries of accumulated wealth evaporate. The courts were overwhelmed with bankruptcy proceedings. And remember, guys, this wasn't caused by war, nor by plague, nor by invasion. Three things that plagued the empire throughout its entire existence, but not this time. It was purely financial engineering gone wrong. The greatest empire in history brought to its knees by a balance sheet recession. For Roman aristocrats, financial ruin was considered worse than death itself. The shame of bankruptcy, the loss of senatorial status, it destroyed not just wealth, but identity. And remember, at this time, suicide, for whatever reason, was totally okay. I can't find evidence that there were suicides around this, but it stands to reason because in every single recession, there are suicides of people that have lost everything. Stands to reason that many aristocrats chose suicide, an honorable exit from the situation rather than facing this themselves. Oh, the Emperor Tiberius faced a choice, the same choice every leader faces in financial crisis. Option 1, let the system burn itself clean, accept a depression, allow creative destruction to reset the economy. Option 2, intervene. What do you think he chose? He chose intervention. Now remember, Tiberius couldn't just print money the way we can today. Rome had a metallic currency system, and the denarius was actual silver. But Tiberius had something else. He had the imperial treasure. Generations of conquest and taxation had filled the vaults with actual coins. So he opened the treasury and he injected 100 million sesterces into the banking system. Here's the clever part. These were not grants. They were loans, interest-free for 3 years, but they required double collateral in land. In modern terms, Tiberius created a lending facility. He didn't create new money. He took dead money sitting in vaults and injected it into a frozen credit system. The Federal Reserve might call it a targeted liquidity provision with appropriate collateral requirements. We can also call it kicking the can down the road. And it worked, right? It worked, sort of. Credit markets unfroze. Some property transactions resumed. The immediate panic subsided. Commerce restarted. But here's the thing that I don't think the history books emphasize quite enough. Rome never fully recovered its financial dynamism. The aristocrats who survived became deeply conservative. They had learned that leverage could kill you. So innovation slowed. The Roman economy shifted from growth to extraction. This is a timeless principle of all recessions. I am sure many of you in your middle school or high school studies of the Great Depression learned about an entire generation of Americans who never took on debt again in the aftermath of the debt-induced Great Depression, heavy margin lending on stock purchases. An entire generation of Americans didn't buy stocks, right? I mean, stocks went out of vogue for like 25 years post the Great Depression. We were always fighting the last war. Now, I think, some conservatism on debt utilization is a good thing and historically is a good thing, but it created a stifled innovation at the same time. And more importantly, I think more important for this discussion, the Emperor Tiberius had set a precedent. He'd proven that when things got bad enough, the government could and would intervene to make the short term better. So even though he didn't print money, he showed that the state could use its resources to prevent systemic collapse. And honestly, guys, once the genie's out of the bottle, you cannot just put it back in. So look at what happened next. Within a generation, Nero debased the currency by 10% by debasing the precious metal standards in the coins. By 200 AD, the denarius had lost half its silver content. By 250 AD, it was down to 5% silver. And by 270 AD, the currency was essentially worthless. Every crisis required more intervention. Each intervention required more resources. When the treasury wasn't enough, they debased. When debasement wasn't enough, they collapsed. And these were not, in this period of time, it's not just financial crises. There's also profligate spending, bad emperors, unnecessary wars. But the precedent was set. that the state could do something to ease the short-term burden. Does that sound familiar? Because it should. It is the same acts that everybody takes repeatedly. And think about this. I thought about this as I was writing the article. It's worth considering. If an emperor who doesn't face re-election makes the decision to ease short-term pain. Now, to be clear, the Roman emperors were absolute rulers, but they were sitting atop a relatively fragile system, right? They had to feed the Roman populace. There was constant concerns of revolution. They had to deal with a restless aristocracy that, resented its powers being taken. But nonetheless, the emperor ruled with force, with the Praetorian Guard, and the ability to exert his will however the heck he wanted to exert it. Think about the pressure on current politicians to think short term because their entire existence is election cycle to election cycle. The ability to make long-term strategic decisions today is probably the worst it's ever been, I think, in human history. So every financial crisis, in my opinion, follows a relatively similar 7-act play. Leverage builds during good times. Something triggers deleveraging. Asset prices collapse. Credit markets freeze. Government intervenes. System recovers. Moral hazard ensures the next crisis is worse. Rome in 33 AD, John Law's France in 1720, Britain in 1866, America in 1907, 1929, 1987, 2008, and 2020. Same story, progressively more massive numbers. And here's the really freaky part. Rome's injection was about 1% of its GDP, based on our understanding of ancient economics. The Fed printed 25% of GDP in 2020. We are not just following Rome's playbook. We are speed running it. And unlike Tiberius, who is constrained by actual metal coins, which can be debased, but it's a little more difficult, we can print infinitely. The only constraint here is confidence. Now, I want to double back really quickly. When I was younger and interviewing at Goldman, I had just come out of the equity research department at Fisher. And Fisher, fantastic firm, great thinkers, had a thesis that 2008 was triggered by regulatory changes. Now, many of you will say, no, it's triggered by over-leveraging, blah, blah, blah. It's all true, right? But what was the thing that popped the bubble, that really popped the bubble? There was a regulatory change pre-08 that required mark-to-market accounting of illiquid securities not held for sale on bank balance books. Just like the specie circular popped something, right? Just like Tiberius insisting on loans being collateralized by Italian real estate and investing in agriculture. SB 10, I think, I forget the exact name of the regulation, required banks to mark-to-market account their books. And all of those mortgage-backed loans in 2008 had to be mark-to-market. So suddenly Lehman's book doesn't look very good, even though they don't intend to sell any of those assets, right? You could argue, and I remember when I was interviewing at Goldman, I told the managing director that ran the office our thesis from our equity research days, and he kind of laughed me out of the room. But I don't think he really knew what he was talking about, to be completely honest with you. That triggered the collapse, right? That regulatory change of assets that are not meant to be sold. And by the way, just to further double down on this point, the government, the Treasury, ended up buying a lot of those toxic mortgage-backed securities, and they made a killing on them, guys. They made a killing. They made a lot of money back on it. So you could argue that the regulatory change is the thing that sparked this. Yes, I know there was over-leverage. Yes, there was all kinds of other bad stuff, but that was the thing that triggered Lehman, Bear, that kind of led to the downward descent. Oh, it's fascinating. So what does all this mean for you? In my opinion, every bailout makes real assets more important. When Tiberius injected those sesterces, where did they flow? Into Roman land. When the Fed prints dollars, where do they go? Into American real estate. The game is rigged, but it is rigged predictably. Cash gets debased, bonds become return-free risk, but real estate captures the printed money and holds it. That is why Italian land prices eventually recovered. That's why property survived every currency crisis in history. And if you know governments will always choose inflation over deflation, bailouts over bankruptcy, and printing over pain, then you position accordingly. You buy real assets, use fixed rate debt, you bet on debasement. I'd be remiss if I didn't say stocks are also a good bet here. And for anybody out there that likes Bitcoin and gold, also good bets. I'm not going to say they're the same, right? I'm not sure where I am on Bitcoin right now. Gold, historically, a great investment class to protect against this situation. Fixed rate debt, guys, is a fantastic instrument for long-term return in a society that debases currency, because the cost of your debt drops over time as the dollar fiat value of the debt drops over time. Real estate is a classic inflation hedge for this exact reason. This is not saying to do this because you want to. It's because 2,000 years of history says you have to. Now, I want to caveat one thing, right? I'm not such a real estate nut that I'm going to say it's great all the time. Real estate didn't do well in this period either, by the way. Real estate doesn't do well in liquidity crises. It didn't do well in 08. It didn't do well in 33 AD. If you were a big real estate holder in the Roman Empire at that time, you probably got crushed, okay? Just to be really clear. What would have worked is not over leveraging. If you took 50% loan on your property and you had ample cash flow to cover your situation, you don't care. Now, the difficulty in 33 AD is everything got called, right? So that's tough. I mean, what can you do? We have some rules today against that happening. So if you look at the scenario and you say, if the regulation that existed today and the laws that exist today that protect you against your lender just unilaterally calling your loan, right? We did a podcast interview 2 weeks ago with the great Brad Minsley. If you haven't checked it out, please check it out. He went through this, right? In 2008, he had $500 million of loans called on him, right? And you would think the lender can't do that. If the project's performing, if you're fine, you're safe. There's an adverse conditions clause in loan documents today that says the lender can call the loan if they feel like conditions have turned against them. And that is very vague. Very vague. Again, 2008 AD, the parallels are wild. So in closing, Tiberius thought he was saving Rome. And maybe he did for a while. He certainly saved his own skin, and he saved the skin of the aristocrats that existed in the Roman Empire. But he also taught every future emperor that crises could be solved with state intervention. And that precedent, once set, is not easy to reverse. Jerome Powell today, Bernanke during 08, they're not doing anything new. They are following a script that's been performed for 2 millennia. The question is, are you positioned for what is coming? Good, bad, whatever it is, are you positioned? If you find value in these historical perspectives, hit subscribe. Every week, we dive into the timeless patterns that drive wealth creation and destruction. Every Wednesday, we will drop a deep dive historic piece. Every Friday, we will drop a deeply researched real estate focused piece because, again, I'm a real estate investor. That's my business. That's what we do. That is what the Timeless Investor is all about. Because history doesn't repeat, but it rhymes really, really well, guys. Really well. This is Ari Van Gemeren reminding you to think in centuries, not quarters. Think well, act wisely, build something timeless. Thanks for being with me today.